Hello, and welcome to this webinar on the limits of easy money. In a world where it often seems that no one can agree on anything, one thing people do seem to agree on is that markets are acting weirdly at the moment. So equities and gold making new highs together and then falling back from them. Worries about debasement and debt levels, and yet here we are with both the dollar rallying and long bond yields rallying, and then growing concern about cockroaches in credit, and yet spreads within a whisker of multi-decade tights. On multiple levels, what lots of people seem to be saying is it just doesn't seem to make sense. So the other thing that people generally agree on is that it's not fundamentals which seem to have got us here. Yes, there's the whole kind of K-shaped economy dynamic, which makes everything a little bit difficult to interpret. And yes, corporate profits are generally in good shape. But for the last couple of years in particular, it's as though markets have just found some new source of fuel over and above anything that you might have explained in terms of fundamentals. Cyclical equities really making all-time highs relative to defensives, or credit similarly shrugging off these individual idiosyncratic concerns more than I think they would have been expected to, normally speaking. It feels more like easy money than it does like underlying fundamentals. And so what I want to do today is give you a guide to navigating in this environment. To do that, I've split my presentation into three. And first, we're going to look in a bit more detail at the evidence that the credit cycle has somehow changed, that markets are behaving differently from previously, basically thanks to an abundance of new money, or what people like to call liquidity. In the second section, I'm going to look at what that wave of liquidity is doing to credit and leveraged finance in particular, and why it hasn't sorted itself out. And then finally, we'll look at where the easy money seems to be coming from and what that implies about how long it may last. But if there's one thing I hope I can convince you of in the next 30 minutes, it's that whatever your investment sector, whatever your investment style, this is something that you need to factor into your investment process. Understanding these easy money dynamics is absolutely critical, because if you fail to do so, you're going to get wiped out, either on the way up as the rising tide floats all boats, or conversely, as the tide goes out and we find out who's swimming naked. There are lots of things to talk about at the moment, so I'm going to go quite quickly through the slides and then leave plenty of time at the end for questions. So I guess the obvious starting point is what happened to the fundamentally driven cycles. Those of you who've only followed my research recently may be surprised that I did used to look at fundamentals once. In the 1990s and 2000s, that was what seemed to be driving markets, these regular processes of leveraging and deleveraging. You could tell where you were in the cycle from the relative correlation of credit and equities. And again, over the last 15 years or so, this just hasn't been a market driver in the same way as previously. So it's not just that different companies are at different stages of the cycle, it's that economic cycles themselves have been longer, they've been more drawn out and more driven by other types of credit expansion than by corporates. If we want to understand this bigger picture, I think we need to look more broadly. And even in terms of that bigger picture, again, the last few years have seemed a little bit weird. For a long time, there was a kind of clear pattern whereby what defined the end of each cycle was a drop in asset prices, triggering a recession. And for several decades, we had this pattern where there was more debt in the system, and it seemed to take a lower level of rates to keep everything going. And yet, what have we had over the last few years? Rates have gone significantly higher than in prior cycles, and nothing is really broken. Indeed, at least until yesterday, it barely felt like there was any correction in asset prices at all. They just carry on going up. I think we need to understand what's been driving this dynamic. What's also been striking over this whole period is how, again, fundamentals have kind of been passengers. They just haven't mattered very much. And since 2012 in particular, a lot of valuation metrics for risk assets broke down. I've written a lot about this previously, I'm not going to say much now, but it used to be the case that when people were revising down their earnings expectations, the equity market would sell off. Since 2012, a lot of the time when earnings expectations are falling, the market is just re-rated higher. Similarly, with all of these uncertainty metrics that are really popular these days, until 2012, they'd be associated with wider credit spreads and higher levels of volatility. Since 2012, just kind of seem, they're not irrelevant, but it's as though something else has been holding down spreads. Even when uncertainty has shot up, spreads and vol really haven't. There's also been a change in the whole way in which the market and the fundamentals seem to have been related, not just in terms of decoupling, but in terms of what leads what. So we're used to the idea that markets don't just respond to fundamentals, they try and anticipate them. But since 2012, it's been stronger than that. It's almost as though markets have been driving fundamentals, maybe through wealth effects, rather than the other way around. So in credit, for example, everyone's favorite lead indicator always used to be the senior loan officer survey. When banks tighten lending standards, then 6 quarters or 2 years afterwards, then you get widening spreads and a pickup in default rates. But since 2012, other way around, spreads tighten first, and then banks ease lending standards afterwards. It's just been back to front. Same thing even with corporate leverage. Often spreads have tightened first and then leverage has come down afterwards, and by more than you would have anticipated if the market was simply doing its own job of anticipating. And I think it's this sort of behavior that people have found really confusing. Most people try and form a view on the economy and then use that view to form a view on markets. But over the last 13 years or so, that simply hasn't worked. Everyone's been scrambling around for alternative narratives instead. And for a while, real yields looked as though they were doing that job. They became really fashionable, especially with equity investors. People would say, oh, it's real yields. When they were really low, that's driven money into risk in general, driven money into growth equities in particular. And people would say, if you understand US real yields, then you will have understood everything. And it's partly related. Yes, when real yields were low, it probably did help drive money into markets, into risk assets. But then real yields went up, and actually there was no derating, actually no money left risk assets at all. If we want to understand what's going on, we need to look a little bit deeper. And the way I think you make sense of this is in terms of credit creation and money flow. Sometimes I say all I ever do is to look at two things: where money is being made or created and where that money is then going. Let me try and explain. Intuitively, we like to think that the asset prices are following the economy. They're following the state of the economy, the state of GDP, the state of corporate profits. And what makes money is when corporates are generating large profits or whatever. But I would argue that most economic activity just moves money from one place to another. What actually creates new money from nothing, what adds new assets and liabilities to the economy, is instead the process of borrowing. And in fact, if you look over the long term, what you find is in almost every economy, the combined market cap of risky assets like real estate and equities more or less mirrors the rise in debt levels. Since 1980 in particular, asset prices have surged relative to GDP and even relative to corporate profits, but they have remained linked to debt. At the same time, though, there's been a change in where the borrowing driving that process has been coming from. Up until 1980, the main source of the borrowing was the private non-financial sector. It was households and corporates. I'm illustrating here with the US, but this argument pretty much holds globally. Then through the 2000s up until 2007, the financial sector became much more important. And then since 2009, things have shifted again. And instead, it's not been the private non-financial sector. Similarly, the financial sector until recently was under pressure. And instead, it was the public sector that was driving things, initially through central banks, also through fiscal stimulus. If understanding markets is all about understanding where the money is being created, then we need to change our focus. And that's what a lot of this presentation does. I think this in turn helps explain why it is that interest rates kind of feel disconnected. It almost feels as though they're just not doing very much. One of the main ways that rates are supposed to have an impact is by influencing how much borrowing gets done, by affecting the supply of credit. But what we see over most of the last decade or so is that in terms of flows of credit, and especially changes in flows of credit, that the aggregate hasn't been determined by you and me deciding whether it's a good time to go out and borrow. They've come from swings in central bank reserves in particular. And I think that's why rates have seemed sort of disconnected. And that's why I've been able to do such a good job until relatively recently of explaining asset price movements using changes just in central bank balance sheets. Often it's felt sort of stupid to be looking at reserves changes rather than the real economy. But when they swing around by $200 or $300 or $400 billion from one month to the next, that dwarfs the short-term changes that we're getting in private sector credit creation and ends up having a big impact on markets. Now, having said all of that, if you followed my research over the last couple of years, you'll also know that that link between risk assets and reserves looks on many fronts to have been weakening. It's still there, but it's as though there's been an additional force pushing markets upwards. And with fund flows in particular, in 2022, when reserves fell and central banks were no longer crowding money into risk, we had actual mutual fund and ETF outflows. But over the last couple of years, central banks have again been draining liquidity. They've taken out about $1 trillion relative to the $16 trillion that they'd added since 2009. Only this time, money carried on pouring into mutual funds and ETFs regardless. Now, that could just be a money rotation. It could just be straight exuberance with everyone feeling positive about AI, but it doesn't feel like it, at least to me. If you look, for example, at links with sentiment measures, then even when sentiment has temporarily fallen down, the inflows have carried on. Likewise, in the past, there was a link with hedge fund performance. And again, that's sort of broken away in a manner that doesn't really feel like it's simple exuberance. It feels more like an invisible hand of easy money pushing everything upwards again. So if we want to understand where markets are going, it looks to me like we need to understand where that easy money is coming from and just how durable it is. So it's that that's pushed us away from conventional credit cycles towards a sort of debt super cycle. And in the last part of the presentation, I'm going to examine in detail where it's coming from. But before we do, I think we'll deepen our understanding if we spend a moment just to look at the impact easy money has on credit in particular. That, of course, is where people are increasingly worried about cockroaches or canaries, following the likes of First Brands. But even if it turns out not to be systemic, I think the dynamics that we can see in public and private credit at the moment are kind of illustrative of the way in which liquidity impacts the system more broadly.